Today, we're going to pull back the curtain on a system that quietly runs the financial world, a system most people don't even know exists. It's a hidden engine, a world of what they call private credit or shadow banking, and it's making a fortune off the money you think is just sitting safely in your bank account. So let's get into it. Let's start with just one number, because it says it all: 0.42%. That's the average interest rate you get on a savings account here in the US. Think about that. For every $1,000 you've managed to save, the bank rewards you with a whopping $4.20 for an entire year. While major institutions are playing in a multi-trillion-dollar private credit market, the average person is getting crumbs. This isn't just a tiny return on your money. It's the very foundation of a business model where you and your savings are the product. So I want you to completely reframe that tiny percentage. Don't think of it as a gain, no matter how small. Think of it as a fee. It's the price you pay for not knowing how the real money machine operates. It's the cost of admission to be a customer of the bank, instead of learning how you can become the bank. And today, we're going to start changing that. So here's our game plan. First, we're going to dig into this 0.42% problem. Then we'll pop the hood and go inside the money machine to see how it really works. After that, we'll introduce you to the 4-pillar mindset to help you take back control. We'll reveal what I call the lender's secret menu, show you how to build your own financial fortress, and finally, map out your very first step forward. Okay, let's dive right in with the problem that affects pretty much everyone with a savings account. That little number isn't just a random rate. It's a symptom of a much bigger economic game, a game that has very clear winners and very clear losers. And let's be crystal clear about something. This situation is not an accident. It's by design. For years, the Federal Reserve has kept interest rates incredibly low. The whole idea was to encourage people to borrow money and spend it, to get the economy going. And hey, if you're a borrower, that's been fantastic. But what about the savers? Well, you're on the other side of that deal. You're the one funding those cheap loans, and you're getting next to nothing for it. So if the savers are getting the short end of the stick in this environment, who's actually winning? Well, to answer that, we need to look inside the very machine that you are fueling with your savings. Let's see how they're actually using your money to make their money. The basic banking model is honestly kind of brilliant. It's a strategy called borrow short, lend long. See, they borrow your money on a short-term basis, because you can ask for it back anytime, and they pay you that pittance, that 0.42%. Then they immediately turn around and lend that exact same money out long-term, like in a 30-year mortgage, for say 7%. That gap between what they pay you and what they charge someone else, that's their profit engine. Your savings are the cheap, high-octane fuel that makes the whole thing run. But hold on, it gets even wilder. Because of something called fractional reserve banking, banks can lend out way more money than they actually have. In fact, as of right now, the reserve requirement in the US is 0%. And this is nuts. It means if you deposit $100,000, the bank doesn't have to keep a single dollar of it in the vault. They can lend out the entire thing. The person who gets that loan deposits it in their bank, and guess what? That bank can lend it all out again. With every new loan, more money is literally created out of thin air. Well, out of debt. And the bank takes a cut every single time, all starting with your initial deposit. This quote perfectly captures the illusion of safety we all feel. You're the turkey on the farm. You feel safe. The bank, the farmer, feeds you a tiny bit of interest. There's a nice fence, FDIC insurance to protect you, and every single day you become more confident that the system is there for your benefit. But you're missing the bigger picture. You're being fattened up. In this system, you're not the customer they're serving. You're the asset they're using. So, how do you hop the fence? How do you get out of the turkey pen? Well, it all starts with a huge shift in your mindset. You have to stop thinking like a consumer of financial products and start thinking like an owner. You need a new toolkit, a framework for building your own financial engine instead of just being the fuel for someone else's. And this is that framework, the 4 pillars of investing. First up is fundamental analysis. This is about knowing the true strength of something, whether it's a company or a whole economy. Second is technical analysis, which is about reading the market itself, the charts, the trends. The third one, and this is the big one for today, is cash flow. This is about learning to make money whether the market's going up, down, or even sideways. And finally, risk management. This is about protecting your turf before you even get started. This isn't just for stocks. These are the tools you need to become the bank no matter what you're investing in. Adopting this mindset completely changes what you focus on. See, the saver focuses on their income from a job. The investor focuses on the income from their assets. The saver is focused on climbing the corporate ladder. The investor, they're focused on building their asset column. Savers save up money so they can buy something later. Investors save up money so they can buy more assets. And this is a big one. The old way obsesses over net worth, but the new way, it's all about cash flow. Because at the end of the day, you can't pay your bills with net worth. You pay them with cash flow. Okay, now for the really good stuff. We're going to zoom in on that third pillar, cash flow. This is where we uncover the actual strategies that people use to get on the other side of the transaction. This is where we learn how to become the bank. So, before we go any further, you have to burn this next definition into your brain. It's from Robert Kiyosaki, and it's brutally simple. An asset puts money in your pocket. A liability takes money out of your pocket. That's it. It's that simple. Now, think about your house for a second. With the mortgage, taxes, insurance, is it putting money in your pocket every month or taking it out? The whole goal here is to collect true assets, things that generate positive cash flow. Check out this story. It's a perfect example. R.C. Willey was a furniture store in Utah. You could buy furniture from them at pretty much what it cost them to get it. They made almost nothing on the actual furniture. So how'd they become so successful? By offering financing at like 27% interest. They eventually became the second largest lender in the entire state, bigger than most banks. They understood the secret. They weren't in the furniture business, they were in the banking business. So think about it like this. On the left, you've got the standard customer menu. The options are pretty limited, right? You can put money in a bank for a tiny return or put it in a 401k and just cross your fingers and hope it goes up. But then there's the lender's secret menu on the right. Instead of just depositing money, you can provide private loans for real estate. Instead of just buying stocks, you can sell options on them to generate steady income. And instead of avoiding all debt, you learn how to use good debt to buy assets that put cash in your pocket. It's a totally different game. Okay, I can practically hear what you're thinking right now. Being the lender, making private loans, that sounds risky. And you know what? You're absolutely right to think that. It can be risky, which brings us to our fourth and final pillar, risk management. This is all about how you build a fortress to protect everything you're building. So let's just tackle that question head on. Is all this stuff risky? Yes, of course it is. But here's the secret. Sophisticated investors don't avoid risk. They learn how to manage it. They learn how to control it. And the way they do that is by building multiple lines of defense. Asset protection expert Garrett Sutton breaks this down perfectly. Your first line of defense is always going to be insurance. It's absolutely crucial. You need it. But it is not a complete strategy. Insurance companies are notorious for finding reasons in the fine print not to pay a claim. That's why you need a second, much stronger line of defense, legal entities. This is a concept called the corporate veil, and it's basically like building a legal fortress wall around your investments. When you put an asset, like a rental property, inside an LLC, you create a separation. If someone sues the rental property, they sue the LLC. They sue the wall. They can't get past it to touch your personal stuff, your house, your car, your savings. And this isn't some secret loophole for the super rich. It's a fundamental tool that any serious investor can and should use to protect what they've built. Wow, okay, we have covered a ton of ground here. We've talked about the problem, the machine causing it, the mindset you need to beat it, and the strategies to protect yourself. So now let's bring it all home and talk about the most important first step you can take, starting right now. And look, your first step is not to run out tomorrow and try to become a private lender. The first step is much deeper than that. It's a fundamental shift in your identity. It's about looking at the world and deciding you're no longer going to be the turkey in the pen. It's a conscious decision to stop being the cheap fuel for someone else's engine and to start, finally, building your own. The 4 pillars we talked about, that's your blueprint for building that engine. You have the framework now. So what's the most logical place to start? You start by protecting what you already have. And for a lot of people, the biggest asset they have is their 401k. That's why your journey continues with our next explainer, where we deconstruct the 401k and show you how to apply these exact principles of risk management to it. So I'll leave you with this final thought. The traditional system, the one we're all taught, is designed to have you work for money your entire life. But what we've explored today is a different system, a different path. It's a system designed to make your money start working for you. So the only question left is, are you ready to learn how?